Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. My name is Pushpendra Mehta, and my guest for today is Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome to the Open Treasury podcast, Craig.
Push, it's good to be doing this with you again. I know we're in different locations today, but thanks for having me back on.
This week, our discussion focuses on important topics, namely interest rate hikes, Russia's SWIFT alternative, cryptocurrency regulations, Apple's foray into BNPL space, Nacha's new partnerships, and the proliferation of ransomware attacks. You can find these articles in the show notes from this podcast or by looking them up on CTMfile.com. The first two stories up for discussion today revolve around interest rate hikes. The European Central Bank has confirmed it will end a long-running bond buying scheme and also hike interest rates by 25 basis points at its July meeting, as it faces a tough balancing act with inflation running at record highs, while the war in Ukraine casts a shadow over the growth outlook. The ECB has also downgraded its growth forecasts and upwardly revised its inflation projections. In Australia, the Reserve Bank of Australia, Australia's central bank, has announced the biggest single rise in interest rates in 22 years to quash inflation before it gets out of control. Inflationary challenges are shared in many countries around the world. Craig, my question to you is that while corporate treasurers continually evaluate the impact of higher inflation and rising interest rates, what are the most important actions that you would recommend they take to be less impacted by this inflationary situation?
Maybe we start with some of the background here on what this means, and then on the response side, we can dive into that a little bit. You know, you bring up some good points on the ECB. You know, one of the, I'll just call them a central bank, right? The European Central Bank, like the Bank of Japan and the Federal Reserve in the U.S. We've seen a long-term quantitative easing, this bond buying activity that's slowing or stopping. The U.S. has talked about quantitative tightening. In other words, selling those back into the market. So the ECB is stopping the purchase. So this, shift to neutral and reversal, we're seeing this take place. Plus the interest rate raise expected there, while it seems fairly small, getting them back towards zero, this shift is notable. Same thing with your comments about the Bank of Australia hiking interest rates again at a higher rate. You use the phrase, or I think the article may have used the phrase about controlling inflation before it runs away or gets too significant. What is too significant? I think it's catching a lot of the central bankers by surprise by how quickly it's been rising. So they're trying to get back even with it, maybe not in front of it, but get even with it. And that's why we're seeing some of these big bumps. I think on the corporate side, the response to this, to your question there, what do they need to do is we need to realize interest rates can move around. This, inflation has an impact on labor cost and may require additional capital, but it also brings us to a situation of whatever you're borrowing, the rates you have, your fixed variable mix is likely to experience disruption, whether it's, during the times now that you're borrowing, when you go to renew your credit, it's likely going to have some higher interest. And that's going to factor into the cost component. So a lot of pressure on costs and care as we're trying to be risk managers. We need to recognize that volatility is always a potential. Now it's very much a reality. And the discipline that most people have been putting in place needs to continue to stay there, be the same. And I think those are a couple things from that push.
Those are great points. The third story pertains to the Russian state-owned company Rostec that says that one of its subsidiaries has developed a blockchain-based international transfer system, which it describes as a real alternative to SWIFT in international settlements. Following the Ukraine war, SWIFT barred access to several Russian banks. But Russia has been looking for a way around SWIFT for years. Craig, what do you think about this development? And do you think it would be a successful substitute with the Rostec devised alternative?
The fact that they've been looking at this for almost a decade, they've been pushing to try to figure out some way to do it. They're making some progress towards this, but will this be a SWIFT alternative? Very diminished alternative. How many countries can you get signed up for this? This is really focused on limited number of countries would participate in this. And it's really geared towards avoiding sanctions, which you can see why a country or nation state would want to do that, especially if they're being sanctioned for certain types of activities. They want to continue to be a trading partner, but there's a problem with trading when that's the case. Even if you build a system that allows you to communicate with some of your trading partners who don't care about the other actions that you're doing that bring about sanctions, you still have an issue. That's a very limited world for a global economy. I don't think it provides a long-term solution. It might mute some of the impacts of what SWIFT has done to limit trading, but it's not a great substitute, even if it does everything they want it to do. As we've seen with some of the sanctions, it's not just the messaging, it's also the actual trading. So there's a lot of trading. There's a number of articles too that have shown up on this week's CTMfile that show, you got to get rid of your Russian assets. You can't sell them to other U.S. citizens, for example. The U.S. is doing that. There's quite a bit of tightening across the board, not just in the messaging network, but across the board in the value stream.
Interesting. The next story is about cryptocurrency regulation making progress in the US, even as a bipartisan pair of US senators unveiled a bill last week that marks one of the most ambitious efforts yet by lawmakers to place clear guardrails around the rapidly growing cryptocurrency markets. Craig, what are your thoughts on this regulatory overhaul?
I have a number of competing thoughts in my head, and so I've not landed on any. A couple things. One is deeming these to be commodities and rolling that into cryptocurrency that seems to be a stretch. Like, why is it a commodity? I think of commodities as physical. It's oil. It's different types of metals. And now we're calling it cryptocurrency as a commodity. That seems a bit of a stretch to try to rein it in and stick it in this case. That's one part. The other is making it so transactions under a certain dollar amount, under $200 US, to be tax exempt. That seems to be positive to remove some of the hurdles and the overhead that would exist in that market. So, Push, you may have more thoughts on this, but they're sort of the plus and the minus of how we're working to regulate these things. I think that just shows a market in great flux, and people are trying to figure out how to do it. And there might be these slight, whether it's overcorrections or not. It's just part of the, monitoring how this is being handled. It leaves a lot of questions in my mind too.
Great. Can we move on from cryptocurrency regulation to another very important development, which was buy now, pay later loans? In that domain, the next story is about Apple's foray into the BNPL space with its own product, Apple Pay Later. Now, Apple has made another significant move into the financial services arena by directly lending to users its new BNPL product rather than going through a bank. Craig, given that the market for credit is tightening and consumers are feeling the inflationary pinch even more, do you think this entry into the BNPL space is a welcome move for Apple, particularly when it has a big cash cushion to lend from? And do you think this is a cause of worry for fintechs in the BNPL space?
The buy now, pay later space, there seems to be quite a bit written on it now. And I think as there's a general tightening of the economy, it's going to become more acceptable. And, as individual consumers look at this and say, does this make sense for the individual buy now, pay later schema that's set up, that decision could be very different depending on the particular consumer. I know this is, most of our discussions on the corporate side, but I think the key tie-in here is they're doing the loans directly. I mean, Apple is sitting on a giant cash hoard, is leveraging this for this space. Part of the idea that Apple is doing this is this a disintermediation play of I'm getting in there directly, I'm leveraging my tech, and I'm acting as a bank or a finance company. The challenge here is Apple financing would still have to be, regulated and follow the rules of a financing company, and then can leverage their enormous balance sheet. I think it's interesting. I'm not a particularly huge fan or supporter of buy now, pay later from an economic standpoint. I think that's wrought with some problems, but, Apple's, trying to make use of payments. How do they put their cash to use? Since they're throwing off so much cash, financing seems to be one way to leverage that or roll that back into the business. So I know that's not a direct answer. It's just some comments, but those are some of my thoughts on this article. Very, very interesting to look at this. I know, Push, we've talked about some other issues over time where we see fintech companies and banks. If you go back a decade or a little bit more, there was this huge concern on the part of banks that there was disintermediation across the board. And as we move forward to the late 2010s to 2020 and beyond, it's much more cooperative and collaborative as opposed to disintermediation activities. This feels a lot more on the disintermediation side, what we've seen of late. So I think that's going to play a factor in some of how banks respond and what partnerships take place.
Great. And you mentioned partnerships. So taking forward the discussion on partnerships to another realm, which is in the realm of security. The last section up for discussion revolves around two security stories. The first one is about Nacha's announcing a partnership with Fixius and Alias Wire that will enable financial institutions, fintechs, and businesses that originate a small volume of ACH transactions to comply with Nacha's web debit account validation rules. Craig, what do you make of this partnership?
Well, I think these are natural progressions on the road to better security and better control. The push by, in this case, Nacha, the U.S. EFT, association, National Automated Clearinghouse Association. This handles these electronic payments. We see that in different areas, from SWIFT to Nacha to the card companies providing standards for how you have to operate as you connect to the network. And so this is just the ongoing industry-wide push to provide support and defense to protect these payment networks. So I am extremely pleased to see this type of thing coming, where verification, validation rules happen. The tools to make this process easier, so it's more streamlined, lends itself to both efficiency and control. And when you can do both of those things together, you're making really good progress against the criminal elements who are attacking, but also progress towards, greater efficiency, less errors. So talking about it from those two concepts, I'm quite pleased with this. I expect to see more of these types of collaborations, the use of these different databases for validation, verification across all payment sectors. Only good can come from that type of activity.
Only good can come out from this kind of activity. You mentioned some very important key points: efficiency, control, and also validation, including criminal elements. So the next story pertains to the article published on CTMfile.com about the proliferation of ransomware that has led to an increase in the frequency and value of cybercrime insurance claims. According to estimates from Cybersecurity Ventures, ransomware is the fastest growing type of cybercrime and is expected to attack a business, consumer, or device every 2 seconds by 2031, up from every 11 seconds in 2021. Christopher Wray, director of the Federal Bureau of Investigation, or the FBI in the US, told the Wall Street Journal in an interview published last year that ransomware threat was comparable to the challenge of global terrorism in the days after the September 11, 2001 or 9/11 attack. Craig, the increasing frequency and size of ransomware attacks are becoming a huge concern for governments and organizations worldwide. The White House has urged companies to treat the threat of ransomware attacks with greater urgency, even as the Cybersecurity and Infrastructure Security Agency in the US announced 2 weeks ago the formation of a task force on ransomware. My question to you, Craig, is what, according to you, are the most important reasons for the proliferation in ransomware attacks, and what should corporations do to protect themselves from the growing menace of ransomware? Just a few couple key points and suggestions would help.
What's bringing this about is the payouts are growing significantly. It wasn't that long ago when the average payout was around $10,000. It rose to over $110,000 and now is sitting at over $500,000. That's the payout. And that's not even talking about what the overall cost is to mitigate it or the average insurance claim. And the article I referred to includes some of those items. So that's number one, is the payout. That's probably the biggest factor is why it's proliferating, is because there's such a significant payout. The other component is directly related to that. It's the level of automation being used on these types of attacks. They're able to automate them so well and get into so many different organizations that they're being very efficient with their time. And criminals, the criminal conference must include how to save a lot of time and still raise a lot of money through this type of crime. I don't know if they actually have a conference, but they certainly share secrets on the dark web about how they're proliferating. So level of automation and the size of the payout means they're getting a lot more efficient and effective at getting money on that. Those are the two biggest things. And then I think your other question was, how do we provide some type of defense against that? It's one thing to read about it and say, hey, these things are going up. This is serious. I would encourage people, if they're not already part of the IT security team, if they're a treasurer, a senior treasury person, they're in payables or some other area, talk to people in your data security and your system security group. Spend some time looking at seeing the number of attacks that come in, how your mail process, quarantines or extinguishes some of these attacks. How many are coming in looking for ports, trying to do some sort of injection anywhere in the organization? If you go and look at that, you take 1 hour and they show you the number of attacks, you are going to be surprised at how much is occurring, how many attempts there are. And you can say, hey, we've gone from being 98% effective at blocking these to 99.9 to 99.999. And it's like the number of attacks is so intense, and they continue to find ways to get around some of these defenses. To realize the seriousness in detail and seeing that is important. Where are people finding weaknesses? They're finding weaknesses not as much through the physical firewall or the digital firewall, but through the human firewall. That's a key thing that Adrian Turpak from TD Bank talks about. And this idea of how do we continue to upgrade the human firewall? There has to be training on defense against things like ransomware, but also, and this, for much of the audience, there's a lot of treasury, payables professionals, is focusing on payment security and understanding that activity, because that's going to, and how you defend against it. That's really, really, really crucial. I think those are a couple components. The other thing that's interesting is two sources where you get this information besides consulting firms. You will get this from your bankers. Your bankers will share information about types of attacks, how to blunt those, how to manage those. But you'll also get information now from your cyber insurer. They will be providing information. They'll have questionnaires. They expect you to follow certain rules because that reduces the level of exposure and the types of losses they're seeing. So it's no longer optional. Oftentimes you can't get coverage if you're not going to follow commercially reasonable procedures that they're outlining. And if they do grant you that, they're going to require a much higher minimum. There's a podcast on one of the Treasury Update podcast channel that goes through some of these items, and maybe we can put that in the show notes. But those are a couple of the things there, Push, that I would mention.
So Craig, finally, what is your choice for the biggest, the most important story of the past week and why?
I'm going to pick cybercrime insurance claims rise as ransomware proliferates. I think the economic items like ECB is stopping bond purchases is a big issue, but we've talked about some of those before. That's just going to continue. So that's less surprising and less reflective of what we need to do as corporate treasury professionals. Yeah, that would be my number two. Number one is the cybercrime. How about you, Push?
I would agree with you. Much as I would have liked, the interest rate hikes announcement that the ECB mentioned and the Central Bank of Australia mentioned, that's obviously a cause of concern. Interest rates, borrowing costs, as you mentioned, increase. Inflation is an issue, and it causes a certain amount of volatility. But I would choose the same story, which is ransomware and the resulting rise of cyber insurance claims, primarily because ransomware is one of the most disruptive and damaging cyber attacks, hitting hundreds of thousands of companies globally in 2021, and has also become the largest driver of cyber insurance claims. That has put the cyber insurance industry under extreme pressure, making it harder for underwriters to effectively price policies and even tougher for companies to buy cyber insurance cover. You alluded to, following stringent norms. So I would choose that as my story of the week. Craig, a big thank you to you and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.